Greetings, folks. This is DC Investing. I've reached financial independence and I'm discussing topics that may help others on their pathway to financial independence. And what I wanted to talk about today is lowering your costs for Obamacare or the ACA insurance. And as a person seeking financial independence, that means that you get away from your day job, your normal employer, and you're trying to live off assets instead of W-2 jobs. And so, if you're trying to retire early, you've got to have a source for insurance, and that means the ACA insurance plan in most cases. So, how do you lower the cost you pay? And right now, there's a whole bunch of the government shut down. The Democrats want to add all the COVID era uh, subsidies back on. I think it's kind of interesting because what they're basically saying is that the program that they originally enacted with the original costs is flawed, and thus they're trying to bring back emergency stimulus in terms of the costs. So without realizing it, they're basically saying what we did originally doesn't work, so we need more stimulus placed on it. But in any case, the subsidies, you do get subsidies depending on your income level. You might get enhanced subsidies if the government wants to bring back those emergency funds. Who knows if that will really happen or not? I'm not sure. But in any case, how do you keep your income low enough so that you get fairly cheap healthcare? Because the subsidies are still there, and they are really good if you learn how to use them correctly. And so, here's some thoughts for what you can do to get some cheaper healthcare. Um, there are some thresholds that you need to be aware of, and how the costs go is they they have something called the poverty level, and there's a different definition for what it is for one, two, three, four, or more people. So definitely you want to take a look at what is the poverty level, and then they have different costs for the insurance plan depending on how far away your multiple is for the poverty level. So as a potential retiree, chances are it's just you and a spouse that are going to need health care. And let's say you're retiring early, a decade earlier than most people. And so instead of retiring at 65, you're retiring around 55 or something. So you basically have to have health care for a decade, and you don't want to overpay for that health care. So this is kind of the strategy for what you can do during that time. And so there's kind of a income threshold where the ACA insurance is a much better deal than otherwise. And I can't remember what the income, like if it's 200% of the poverty level or 250% of the poverty level. I'm not really sure. For two people, poverty level is defined as about, from memory, $21,000. And so the 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 insurance program changes for two people when you earn just slightly above $42,000 a year. I don't know if it's 42,500 or something like that, but something to keep a look at is not only the premiums that you're going to pay every month, but also the out-of-pocket and the deductible. There's a huge gap that happens once you cross that threshold, and it's about $42,000, just over that for two people. And so your total out-of-pocket changes from, if you make $1 over that, your out-of-pocket changes from $7,000 to something like $16,900. So that's more than a doubling of the cost if you cross over that threshold. And then your out of pocket before the deductible kicks in is also right about there. And so you're out of pocket something like $3,300 for less than 42,000, and you go just slightly above it, well, you're out of pocket's like $8,000. It triples, not triples, but more than doubles. So the idea is to try to aim to keep your income below $42,000. And so the income that this is based upon is called the MAGI. I think it's modified annual gross income is what it stands for. But a lot of things, a lot of income gets counted in that, even more so than counts for your federal taxes. So even something like an I bond counts as income for the MAGI. T-bills and T-bonds, government debt all count as income. I think even municipal bonds count as income for MAGI. Real estate income counts. Bonds or qualified dividends that don't count under certain income amounts for federal taxation do count for MAGI. So it's really important to kind of learn all of the income sources that count towards the MAGI and see if you can't manipulate your yearly income to the point where you keep it below $42,000. And for someone that's retiring, that's the trick: is can I keep my reportable income below $42,000 so I get better subsidies from the government? And you might think, hey, well, I can't live on that amount. That's just not enough. I guess in some areas it is enough to live on, but a lot of it that wouldn't be enough. But you start to look at the things that don't count. So if you have money that's not in a retirement account, your brokerage account or a bank or a CD or something, just using money that you already have does not count towards MAGI. So, if you have $1 million sitting in your brokerage account, you could pull $100,000 out of that account every year for 10 years and show basically zero income, and thus get big subsidies. Now I will say you do need to have some income, and I can't remember where the threshold is, but you need to show more income than the crossover for Medicare or Medicaid. I think it's Medicaid. So you don't want to be pushed down into Medicaid areas. So you've got to have some income. That might be somewhere like 23,000 a year or something. I can't remember what it was exactly. So the ideal is to keep your income somewhere between like 23,000 and 42,000. So here's some strategies for what may be happening. Now, if you're in the fire community, the goal for many people is financial independence, retire early. But there's also another acronym I like, which is financial independence, recreational employment. So you may decide to quit from, say, a 40-hour job that would typically provide insurance, and then instead do some freelance work or something else, just for fun, that creates some income. So that some income is reportable. Let's say you have $25,000 of income, but then the biggest thing is you've got investments that are also needed in order to provide income. So things that do count as income are any dividends that you get, whether they're qualified dividends or ordinary dividends. That counts towards your MAGI. And any CD interest you get counts towards MAGI. Any money market fund interest or dividends counts as MAGI. Real estate income counts as MAGI. Long-term and short-term capital gains both count as MAGI. So if you're trying to be financially independent, typically you need lots of assets that provide income for you to live on. So you've got to kind of take a look at the plan for what are you going to be pulling funds for. So if you've got dividends, you've got to include those. So let's say you have $15,000 of dividends that are coming in. You might sell a little bit of stock for another $5,000 or $10,000. I don't know if you have bonds or CDs or money market accounts. All of those count towards your MAGI, and you've got to keep that below $42,000. So if you have $30,000 or $40,000 in investment income coming in, and you also work a little bit and earn, say, 25 grand or something, you're going to have an income that's above the MAGI level, and you're going to miss out on these better subsidies, and also your out-of-pocket costs go up hugely. So what can you do? So things that hide income from MAGI is IRA contributions. So a lot of people, when they're in this time of life, they think about pulling money out of their retirement account, but you can actually push money into your retirement account to get better subsidies on healthcare. So any individual gets that. I think it's the threshold's like $7,000. If you're under age 50 or 55 or something, it might go up to $8,000 if you're over that age, and that goes for both you and your spouse. So I think if you're over 50, or 55, I can't remember what it was. I think you get an $8,000 contribution, and so does your spouse. So you could take of that $25,000 you earn and put $16,000 of it into a retirement account, an IRA, and that is not reportable on your HS or on for MAGI for the ACA thing, and that might make a huge difference for you. You might think, well, I'm trying to pull money out of retirement accounts instead of put money into it, but the subsidies are so good that makes a difference. And you could even like plan on being in a lower income amount all through the year. Let's say you didn't have any health needs, you didn't go over your out of pocket, you didn't go over those annual maximums or something, and then you choose at the end of the year, well, hey, we didn't really spend a whole lot, we're going to pay a little bit more in premiums this year, but so we're going to do a Roth conversion, or you can pull money out of your retirement account at the end of the year, and just pay more for your ACA insurance that year because you didn't really use it. So that's an advanced strategy to say, plan every year to be under $42,000. But let's say you had no major health issues, you didn't go cross your out of pocket. You could decide that one year, hey, let's pull another, $40,000 out of our retirement account, which means you'll owe back premiums, but it can still be a better tax situation than just paying the extra premium for the ACA insurance. So another thing that counts against MAGI is a 401k contribution. And kind of the thinking is, if you have a job that has a 401k, chances are you have health insurance from that job, but you don't need it. But here's a strategy. Let's say you're planning on retiring in 6 months or 3 months or something. You can, as a strategy, and you want low health insurance costs, as a strategy for, say, the first 3 or 4 months of the next year, you're working at your W-2 employer, you can ramp up your contribution to your 401k account to absorb a huge amount of your salary. So, let's say taxes and other things take out 25% of your paycheck. If you can ramp up your contributions to 401k to something like 75% of your income, then all of that 75% gets canceled out for MAGI. And so, I don't know like what the salary might be, but you might be able to work for 3 months of a year, put it all towards your 401k, then quit, then go to switch to the ACA insurance, and still have really cheap premiums because you're not going to show any income that's countable towards your MAGI. So that's kind of an advanced strategy. You kind of have to, plan if you're heading into retirement and need to switch from a W-2 health insurance program to the ACA insurance, but you can strategize there. So you can put everything towards your 401k, show almost no income, get lowered MAGI. You can put money into an IRA to get lower MAGI. Between you and a spouse, let's say you're older, that's up to $16,000 of income that you can kind of hide by putting it into your retirement accounts. And let's say that's coming from dividends, or you've got some stock you need to sell. You got to harvest those gains, but you still want your income to look lower. Put it in an IRA, and that kind of hides it. I do think you have to have some earned income, like at least one spouse needs to have earned income of that IRA amount, and then the other spouse, you can still make a contribution for the other spouse. So that's kind of one of the little nuances. And again, this isn't tax advice. I'm not a financial analyst. I'm just kind of, here's some of the things that I've learned that can help you. And then there's one more thing that I have learned that is really interesting and useful. Actually, there's two parts. If you're a real estate person, you can depreciate your assets to wipe out income from real estate. So if you're using those strategies, I do believe that the amount that you clear on your your income from real estate, that counts towards your MAGI. But I believe you can depreciate your assets to wipe out a lot of that income, and thus it doesn't show up as income. So the other thing that works to lower your MAGI is return of capital. And this, in most cases, gets paid like a dividend, but it is not a dividend. So the sources that you get return of capital that I know of, I'm going to talk about master limited partnerships. I believe there's some real estate syndicates where you get return of capital. And I think there's also some covered call ETFs that pay return of capital rather than a dividend. And so all of these substances, or all of these different investments, you can be invested in them, get revenue from them, but it does not count towards your MAGI. And so to be extreme, let's say you have $1 million invested across the 6 largest master limited partnership pipeline companies. So you've got investments in Energy Transfer, Energy Production Partners, Western Midstream, MPLX, Plains All American, and maybe the Sunoco or something. So, so you've got $1 million spread across those. On average, they're going to pay 7.5% of a dividend. It might be a little bit higher than that right now. But let's say you're getting 7.5% dividend. That's a yearly payout of $75,000, which would put you into an expensive healthcare plan if it counted as income. But by definition, return of capital is not income. They are just giving your money back to you again. So in this case, you've got $75,000 to live on that doesn't count towards MAGI. So that opens up the ability for you to pull some money out of a retirement account, or get some qualified dividends, or some ordinary dividends, or some capital gains. And so it gives you a high amount of flexibility for keeping your health insurance costs low, getting maximum subsidies, while at the same time having the income that you need to live on. So those are awesome strategies that I have learned about to help manage your healthcare costs. It's all about understanding what MAGI is. It's different than adjustable gross income that you see on your taxes. More things are included into it. But if you can keep your MAGI low enough, then your healthcare costs can be really low. And if you have the right type of revenue sources coming in, then some of those don't count towards your MAGI. You can use retirement accounts. Oh, one more thing. If your ACA insurance has if it's a low deductible plan and has a HSA available, any funds that go into the HSA also don't count towards MAGI. And so if you're working at a W-2 employer but plan to retire, just know that your ACA or your MAGI the HSA funds contributions don't count towards MAGI, nor do 401k. And look into it, but the costs that you pay towards your medical premiums while you still have your W-2 job, they also may not count towards your income. So all of those can kind of help you be strategic about when you want to retire or when you don't. So all of these are some things to think about. If you can keep your income as for 2 people below $42,000, ACA is fairly affordable. Your out-of-pocket is small, and your deductible is also reasonable too. So take a look at that. Hope this helps. Like, subscribe, comment. Did I help with any? I give you some ideas with any of these comments today. If you made it to the end, kudos to you. You're trying to learn. I'd love to hear your comments. I'm kind of just giving this information out to help others on their path to reaching financial independence. And I study this a lot myself, and I'm just trying to pass that information along to you guys. So thanks a bunch. We'll see you. Bye.